Hey everyone, welcome back to MarketSnap. When a stock like EYPT loses over 60% of its value in a single week, it's easy to let emotions take over. But today, we're slowing down, we're checking the MarketSnap valuation model, and we're asking the real question. Did price move faster than fundamentals, or is the market finally pricing in reality? This is EyePoint Pharmaceuticals, a name that was once a high-flying biotech darling, and now it's at the center of a massive clinical and financial storm. We're going to break down exactly what happened, what the numbers say, and where this stock could go from here. First, let's set the stage. EyePoint Pharmaceuticals is a biotech firm headquartered in Watertown, Massachusetts, focused entirely on developing ophthalmic solutions, treatments for eye diseases. Their lead candidate, Duravyu, a vorolanib intravitreal injection, was supposed to be their ticket to the big leagues, targeting wet age-related macular degeneration, or wet AMD, a massive market. The company has a market cap hovering around $450 million, and they're burning through cash, as you'd expect from a late-stage clinical player. This isn't a company that's generating meaningful revenue from its pipeline yet. It's a binary, event-driven stock, and that's what makes it so volatile. Let's talk about the revenue picture, because it tells you everything about where this company is in its life cycle. For fiscal 2024, total revenue came in at just over $43 million. But, and this is a big but, that number is almost entirely composed of license and collaboration agreements, roughly $38.5 million of it. Actual product sales are tiny. We're talking about $3.1 million in YUTIQ product sales and a little over $1.6 million in royalties. The geographic split shows almost all of that money coming from the United States, with a small contribution from China. This is a company with one foot in the commercial world and both eyes on a pipeline that hasn't delivered yet. Now let's get into the earnings, because this is where the story gets really interesting. The company reported a Q2 2026 loss of $1.09 per share, which was wider than the consensus estimate of $1.92 loss. Revenue did beat expectations, but that's a low bar when we're talking about a pre-commercial biotech. Looking at the full year 2025 numbers, the net loss widened dramatically to over $231 million compared to a $130 million loss in 2024. That's a massive jump, and it's a direct result of the aggressive investment in the Duravyu clinical program. The operating cash flow burn is also accelerating, with over $240 million used in operations in 2025. The market is paying for progress, and right now, progress has stalled. When we dig into the balance sheet, there are a few things that stand out. The company ended 2025 with about $101 million in cash and cash equivalents, plus another $204 million in total investments. That gives them a current ratio of over 4.5, which is a healthy liquidity buffer for a company at this stage. But the broader trend is concerning. Total stockholders' equity is around $306 million, and the retained earnings deficit is over $1.1 billion. They're also burning through cash at an unsustainable rate if the pipeline fails. The debt-to-equity ratio is low, which is good, but the free cash flow yield is deeply negative. This is a balance sheet that's built to survive a clinical readout, not to sustain years of commercial losses. This brings us to the SWOT analysis, and honestly, this is one of the most clear-cut cases I've seen in a while. Starting with strengths, the company has a substantial cash position and a strong balance sheet relative to its burn rate. They have a proprietary drug delivery platform that's differentiated. The weakness is glaring. The lead asset just missed its primary endpoint in a pivotal phase 3 trial. That's not a minor setback. That's a fundamental blow to the investment thesis. The opportunities now lie in the second phase 3 trial, which is expected to read out soon. If that trial succeeds, the story isn't dead. But the threats are severe: a failed program, potential regulatory hurdles, and the massive overhang of shareholder litigation that's already started to pile up. Let's look at the chart, because the price action is brutal. Over the past week, the stock is down over 60%. Over the past month, it's down nearly 59%. The 6-month performance is down over 65%, and even over the past year, it's down 54%. This isn't a dip, this is a repricing. The stock is now trading around $5 and change, down from double digits just a few months ago. The market is pricing in a high probability that the program fails entirely. The volatility is extreme, and for a stock like this, short-term moves are going to be driven entirely by headlines and clinical news flow, not by fundamentals. So what's the stock actually worth? This is where we pull out the MarketSnap valuation model. Given the company's negative earnings and pre-revenue status, standard models like forward PE and PS are essentially blocked. The only viable engine here is the price-to-book model. The model applies an industry average PB multiple of 6.5 times to the company's book value per share of roughly around $3. That gives us a fair value estimate in the neighborhood of $16 per share. Now, keep in mind, the stock is trading at around $5 today, which puts it well below our model's estimate. The model's output suggests a fair value of somewhere around $16, with a DCF cross-check landing in a similar range. That implies there's a gap of maybe 60 or 70% between the current price and our rough fair value. But here's the catch. The model is only as good as its assumptions. The PB multiple could compress further if the book value erodes, or if the market completely loses faith in the pipeline. We're assuming dilution slows from the historical rate to around 20% annually, which is a big assumption for a company that may need to raise capital. Changing any of these inputs can swing the fair value dramatically. If you disagree with our assumptions, you can plug in your own growth or discount rate assumptions on our intrinsic value calculator at MarketSnap.com and see how the number shifts. Here's my take, and I'm going to be direct with you. This stock is a speculative binary bet at this point. The first Phase 3 trial failed, and that's a catastrophic event for a company whose entire valuation was predicated on DuraView's success. The model says the stock is undervalued relative to book value, but book value is a poor anchor for a biotech with no approved lead product. The upside is entirely dependent on the second Phase 3 trial, which is expected to read out in the coming months. If it succeeds, the stock could recover significantly. If it fails, the stock could go to near zero. On a 5-year horizon, a $10,000 investment today could be worth somewhere around $12,000 if the base case plays out and the company stabilizes. But that base case assumes the second trial hits. The risk here is asymmetric, and it's heavily skewed to the downside. What do you think about EYPT? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.